It's another perfect afternoon. We meet again for this live session. So students of CPA, I think this is your opportunity so that you can be able to at least grasp something for today. So for today, I would like to look at financial reporting and analysis. So under this financial reporting and analysis, we'll be doing consolidation question. So under the financial reporting and analysis, so I would like to look at a consolidation question. So the consolidation question. So consolidation. So that is for April 2024. April 2024 question 3. So remember that when we talk about consolidation, this is whereby you find that there is one entity. Let's say there's a parent company which had acquired a subsidiary. It can acquire other than subsidiary. You can find that there's another entity which was acquired, like a joint venture. Other than joint venture, also you can find that there's an associate which is acquired. There's an associate which was acquired. So remember that the parent company, this is the main company which acquires the other entities. So for you to know that the parent had acquired a subsidiary, so the acquisition must lie between the percentage of 50, that is 50 plus 1, 50 plus 1, towards 200%. So for an entity to be called a subsidiary of the parent, the percentage of acquisition must lie between, in short, I can say 51 towards 200. So it can be 70% acquisition, it can be 60, it can be 80. So for a subsidiary to be a subsidiary of the parent, the percentage of acquisition by the parent, it has to lie between this. Then for this one, it has to be exactly at 50%. Exactly 50%. Then for this, is all about 20% to 49%. To 49%. So the 20 to 49%. So let's look at April 2023. FR. So that is FR, Financial Reporting and Analysis. Kasneb. But remember, for financial reporting and analysis, it cuts a close. Meaning that it cuts a close other than being tested by Kasneb, it can be tested with other examination bodies, including NEC, for other foreign examination bodies like CCA. FR is there. We have the likes of ICPAL for Rwanda, the likes of ICANN for Nigeria. So, because financial reporting and analysis, this one is based on standards, the IAS, International Accounting Standards, and IFRS. So, doing this, I know it will not only assist the students of Kasneb, but also the other students from other areas. So, for the guys who doesn't have the past paper for this, that is for Kasneb, I'm going to share the link under the chat. So the link under the chat, so that link which is under the chat, you can use it to access this past paper for RAS sitting April 2024. April 2024. So for me, I have the hard copy, so I will be reading, and I know that you have opened from your end. You have opened from your end this relevant past paper. So this is question number what? I said question number 3, April 2024. Financial reporting and analysis. It's a consolidation question whereby they are saying that we have Borrow Limited acquiring 90% of the ordinary shares of 10 per value in Soro Limited on 1st November 2021, paying shillings 30 per share. The balance on Soro Limited's retained reserve as at this date was 9,600. On 1st May 2023, Poro Limited acquired 30% of Allo Limited is shillings 10 ordinary shares for shillings 35 per share. The statement of financial position of the three companies as at 31st October 2023 are provided below. Statement of financial position as at 31st October 2023. So you are given a statement of financial position here. So you have that one for Poro, for Soro, and for Allo. So additional information is given. Number one, the details relating to revenue reserve were as follows. So you have for the three companies, the revenue reserve as at 1st November 2022, and the retained earnings for the year ended 31st October 2023. It's the group's policy, that is number two, it's the group's policy to value non-controlling interest at acquisition date at fair value. So the fair value of the non-controlling interest on 1st November 2021 was 3,600. So remember that there is Soro which was acquired at 90%. So this Poro acquired. So this Poro acquired. So I want to interpret that additional information number two before even we go deeper. So we have Boro, which is acquiring two companies. We have Soro and we have Allo. So this one is 90%, this one is 30%. So under this Soro, remember that it was not acquired 100%, meaning that here we have an NCI, non-controlling interest of 10%. Non-controlling interest. So the percentage unacquired in the subsidiary is called non-controlling interest at 10%. And they are saying that in note 2, it's the group's policy to value non-controlling interest at acquisition date at fair value. So meaning that when you will be computing for your goodwill, you have to use the full method. So that is a guidance. So when the non-controlling interest as at the acquisition date is measured at fair value, they are trying to guide you that when you will be computing for the goodwill of that relevant subsidiary, here is Soro. When you will be computing the goodwill of Soro, you have to use the full method. Number 3, a check of 480 from Soro Limited to Boro was not received until 3rd November 2023. And remember that our financial year was ending when? The current one. The current financial year ends on 31st October. It ends on 31st October 2023. It starts on 1st November 2022. So there was a check of 480 million from Soro to Boro, was not received until 3rd November. So 3rd November, remember, it's a few days after October. So after the financial year, after the end of the financial year. Meaning that by the end of the year, that amount was on transit. That amount was on transit. So intercompany balances are included in the accounts receivable and payables as appropriate. Number 4, in October 2023, Poro Limited sold goods to Aro for 480 million. These were transferred at a markup of 30% on cost. 2/3 of these goods were still in the inventory of Allo Limited as at 31st October 2023. So they are saying that Poro sold goods to Aro for 780. So these were transferred at a markup of 30% on cost. So if we were to determine UPS, remember that there is this goods sold to Allo from Poro. So by the end of the year, you need to check, did the Allo resell all these goods? So remember that Poro sold at 400, that is 780, not 4, 780. When he was selling, he sold them. So they said that these were transferred at a markup of 30%. So 2/3 of the goods were still in the inventory. So if you take 2/3 of 780 times the profit margin, you will be able to get unrealized profit on the unsold stock. in the books of allo. Number 5, just prior to its acquisition, Soro Limited was successful in applying for a 6-year license to dispose of waste products. The license was granted by the county government at no cost. So yeah, there is what we call right to the usage of the asset. So, however, Soro Limited estimated that the license was worth that is 2,160 million at the acquisition date. We'll account that one. On 1st November 2021, Soro Limited owned an investment property that had a fair value of 1440 in excess of the book value. The fair value of this property had not changed since acquisition. So there's this Soro which owned an investment property that had a fair value. When we have a fair value being in excess, fair value being in excess of book value, fair value is in excess. Fair value is in excess of book value. So when the fair value is in excess of the book value, that is what we call revaluation, or what we can term as fair value uplift. The fair value uplift of the asset. The fair value uplift of the asset. So we will carry out an adjustment to that. So the first thing they require the student to do is to do what? Is to compute goodwill, and then we do the statement of financial position. Compute goodwill, then do statement of financial position. So that is what we'll be able to do. So let's start with goodwill of the investments, of which already I've told you that, or as we are told in that equation, that we have a subsidiary being acquired, and at the same time we have an associate. So let's start with goodwill of Solo. So goodwill is equals to purchase consideration minus net assets. So on this scenario, I would have to mention about the purchase consideration. Purchase consideration, was it given direct? So purchase consideration. So what they said in terms of purchase consideration is that when a Poro was acquired at 90%, remember Poro Limited acquired 90% of the ordinary shares of shillings 10 per value in Solo. So there was he acquired shares, 90% of their par value was at 10. But he paid what? He paid shillings 30. He paid 30 as at 1st November 2021. So those shares currently they were going at 30. So the par value of the shares is shillings 10. But now the fair value is 30. The fair value is 30. Which shares? You go to the statement of financial position. So you check Soro, statement of financial position under the ordinary share capital. So the ordinary share capital in Soro is 14,400. So to get the number of shares, remember the power value is 10. So the number of shares is 14,440. The number of shares is 1440. So I will come here and say, remember you acquired 90%. 90% of the 14,400 divided by 10 to get the number of shares times the fair value. Times the fair value, which is shillings what? 30. So if you do that, if you take 0.9 times 14,400, that is 1440 times 30, I'm getting 38. So this is 38, 880. So remember, shillings here is in million. So that is purchase consideration. Purchase consideration. That is the purchase consideration. Alright, so after purchase consideration, we have to deduct the net assets. But now before net assets, which are supposed to be deducted. Remember, we are using full method. We are using full method because already we were told that the NCI is stated at fair value. Non-controlling interest stated at fair value. But we were not provided with the fair value of NCI. So in this question, that is not did they provide? Yes, they provided. So we don't have to compute. So note 2, they said it's the group's policy. It's the group's policy to value non-controlling interest at acquisition date at fair value. The fair value of the non-controlling interest on 1st November 2021 was 3,600. So that is what you add here. So after purchase consideration, because it's full method, you have to consider the fair value of NCI. So add fair value of NCI, fair value of the non-controlling interest, 3,000 what? 600. So if you add that one plus 3,600, I'm getting 42,480. 42,480. Then now we'll go ahead to deduct what? Fair value of net assets acquired. Fair value of net assets acquired. The equity components, that is. Net assets are equity components. So the first net asset, so I can have another column here of millions. So the first net asset is ordinary share capital. Ordinary share capital. Ordinary share capital. So the ordinary share capital from the question is 14,400. Then after that, there was retained earnings, the revenue reserve. Revenue reserve is same as retained earnings, revenue reserve. But remember this one, revenue reserve, it has to be as at acquisition date. So you need to check under your question, are you provided with the revenue reserve as acquisition date? As at the time this was acquired. If you check at the start of the question up there, somewhere they said the balances on Solo's retained revenue as at this date was 9,600. So at acquisition, at acquisition date, you know that. So revenue reserve at acquisition 9,600. Then next, you need now to check the fair value uplift, the one I explained about, the fair value uplift. The fair value uplift on the assets. So in note 6 and note 5 consecutively. So that is 5 and 6 consecutively. So note 6, they said on 1st November 2021, Soro owned an investment property. That had a fair value of 1,440. But here we need to do an adjustment because there was license, which must be adjustments to fair value. Adjustments to fair value. Or we just say fair value adjustments. That is what we can say. So fair value adjustments to these assets. So fair value adjustments. So we say fair value adjustments. So we have the investment property. Investment property. For investment property, it was 1,440. Then there's that note 5 for the license. We need to record it here. License, which is a right to the usage of the assets on disposal of the waste. So our license there is 21 what? 2160. So this one totals to. So 1,440 plus 2160. That is 3,600. So fair value uplift. So about 3,600. So those are the net assets to be recorded there. So if I get the total, for this net assets, 14,400 plus 9,600 plus 3,600. So this is 27,600. So I deduct from 42,480. 42,480 minus 27,600. So that is 14,880. So that is goodwill. That is goodwill. So if there was impairment, remember we could have deducted. So impairment, if we were given a percentage, we could have said impairment, a certain percentage for this one, 14,880, so that we deduct, so that we get what? We get net goodwill. But for this one, we don't have impairment. So our goodwill was not impaired. Our goodwill was not impaired. So the next one we do is all about the goodwill for allo. So purchase consideration. Remember here we have shillings in million. Shillings in what? In millions. So we can have two columns. So shillings in millions here, and we have shillings in millions there. So the purchase consideration, when allo was acquired, on 1st May 2023, Boro acquired 30% of the allo limited is shillings 10 ordinary shares for what? Shillings 35. For shillings 35, that is the market price of the share. That is what he paid when he was acquiring the shares of that company. So you need to go and check the ordinary share capital of allo is stated at which value? That is under the statement of financial position. So ordinary share capital is stated at 7,200. 7,200, of which we know that the par value of those shares, par value, when the shares are stated in the books, they are stated at par value. So, and that is what we were told up there, that on 1st May 2023, Poro Limited acquired 30% of the Aro Limited is shillings 10 ordinary shares for 35 per share. So to get this purchase consideration, we take the percentage of acquisition times the number of shares acquired, which is the ordinary share capital, divided by the par value to get the number of shares, times now the fair value of 35. Times the fair value of 35. So 0.3 times what? 720 times 35. So here you get 7560. All right, then we do what? We less net assets. We less the net assets acquired. The fair value of net assets acquired. So again, you can go to your statement of financial position, ordinary share capital. Our ordinary share capital is 7,200. Then we have revenue reserve. Revenue reserve is same as retained earnings. Revenue reserve at acquisition date. So if you look at the timing, not even timing, before I look at the timing, if you go to the question, you go back to the question. You go back to the question, try and check if you are provided with revenue reserve as at the time allo was acquired, of which it was acquired on 1st May 2023. They never mentioned about the revenue reserve as acquisition date. But for Soro, they gave us the 9,600. So meaning that this one, we need to do an analysis. So our financial year was ending the 31st October. Our financial year ends on this date, 31st October 2023. It starts on 1st November 2022. It starts on 1st November 2022, of which allo was acquired during the year 1st May 2023. From 1st May to October, and from November to May, how many months are those? So November, December plus 4, these are 6 months, and these are 6. As acquisition date is as at this date, the pre-acquisition period. As acquisition date is this time, the first 6 months. As acquisition date, as at this time, is from here to here. So let's check the data given. So if we look at our additional information number 1, we have a revenue reserve 1st November 2022. We are talking about our law. So we have here 9,600. Then for the year, retained earnings for the year ended at 1st October 2020. So for the year means that this period for the year is 72. So this period, so you can be able to get as acquisition date. You can be able to get as at acquisition date. Because if I take 96, then this for the year I apportion is for the first 6 months. So plus 6/12 times the 72. The answer I will get from this, I add to 96. I will be able to get my retained earnings as at this date, as at 1st May 2023, which is the acquisition date. So 7,200 divided by 2 plus 9,600. So this is 13 what? 13,200. So here is 13,200. So 13,200. So the total of these two, we don't have any other net assets, plus 7,200. So the total of the two is all about 2,400. So 2,400 total net assets. Net assets 2,400. But now we have to apply the share. So yeah, I could have said share of net assets. Share. So share of what? So share of net assets. So remember the acquisition was 30%. So the share is 30%. 30% of 2,400 is 6120. So if you deduct that one, so 7560 minus answer, so that is 1440. So that is goodwill. So we have answered this question, the first part of it. Consolidation, April 2023. That is a FR, not a FR. This is financial reporting. They call it financial reporting and analysis. From Kasneb exams. But also it cuts are close. Not even Kasneb only. Even NEC can test these. Even other bodies like ACCA, the likes of ICPAL, the likes of ICANN for Nigeria. So this was the first part of it. It was having 4 marks. Part A. I can be able to tell you how they marked this. How this one was marked. So let's check. Or let me just mention how this one was marked. The 4 marks. How you were supposed to get those 4 marks. So for this one, they were marking this one, this, and this. So here, out of 1, 2, 3, 4, 5, any 2 entries, any two correct, they multiply by 1, you get 2. Then for this one, also this, and this. Again, any correct 2 at 1, you get your 2 marks. So 2 plus 2 marks, that is 4. 2 plus 2, that is 4. So this is A. for financial reporting and analysis, Kasneb exams, April. That is our sitting anyway. The next exam would be August. The next exam would be August. So we can go ahead and do part B of that question, part B, which was having 16 marks, where they needed us to do group statement of financial position. The group statement of financial position. So Amera, I can see you are saying whoa, good. So that is good. I appreciate. So Amera, you can share this to other students. Your colleagues also, you can request them to join my online classes. Besides this, Amera, beside what I do here live, there is classes I do. There is classes I do for financial reporting and advanced financial reporting during the evening hours from 8 p.m. Kenyan time to 10 p.m. So students have joined not only from Kenya, but even from Rwanda, from Nigeria, and also I have one student from South Africa. So let's do part P. So, and for you to join, my number, I will be able to share it under the chat. Whoever want to join, you can be able to contact me so that we can agree on the way forward. So let me share my number for whoever would like to join the online classes, which are done during the evening hours. So that one, you can use it for WhatsApp or you just call. I have shared it under the chat. So let's do part B. Part B of the question. So this was part A. Part B is having 16 marks. 16 marks. And for the guys who are joining at this moment, the past paper also is under the chat. You click the link, you access the past paper. You go to question number 3. You go to question number 3. I can see even there is another student here called Mukonyo. Mukonyo, karibu sana. Thank you for following. And I share this to other platforms. So, for this, when there is a Poro acquiring subsidiaries, so you add subsidiary, you add Poro and Soro. We don't add associate, but for associate, we'll consider some other items, like now profits, dividends. But most of the items we add is that of the parent plus subsidiary. So it's Poro and Soro. So I'll come and say Poro Limited, group statement of financial position. Group statement of a financial position. Group statement of financial position as at 31st October 2023. As at 31st October 2023. So here we say shillings in million. So when doing this, we start with non-current assets. We start with non-current assets. The non-current assets. So for the non-current assets, the first one is property, plant, and equipment. Property, plant, and what? Property, plant, and equipment. Property, plant, and equipment, of which you take the parent plus subsidiary, 9,600 plus 43,200 plus the 43,200. So there is no another adjustment for this question which can be carried out. So 9,600 That is 96,600 plus 43,200. So this is 139,800. 139,800. Then next thing is goodwill. So we have the goodwill of Soro, and also we need to consider the goodwill of Allo, beside the investment in Allo using the equity method. So in Soro, remember we did our working. We did the first requirement. It was 14 what? The goodwill. 14,880. Then for this, another from part A. Not even working. I can say from part A. From A. From A. From requirement A. So this is 1440. Then after that, also we need to consider the investments in what? Investments in Arrow. So using the equity method, using the equity method. So which using the equity method, So investment in associates. Investment in associates. So the investment in associates. So for the investment in associate, we start with the initial cost of investment. This is according to equity method. Initial cost of investment in Allo. Remember, Allo is the one which is an associate. Initial cost of investment. The initial cost of investment was, we determined this. We said 30%. Remember, when this is just the purchase consideration. Remember, we did this. It was 10 shillings 35. We determined that 75.60. You remember this? We did it when I was doing the goodwill of this Allo. So initial cost of investment was 75.60. The 75.60. So initial cost of investment, add post-acquisition profit. You add the profit, which was there during that period. This company existed from this period to the end, from May to the end of the year. This is the post-acquisition period. Post. Add the post-acquisition. Post-acquisition what? Post-acquisition profit. Of which you remember that as at the end of the year, this our financial year was ending October 2023. It was starting on November 2022. This company was acquired on May. That is 1st May 2023. So the post-acquisition period is 6 months. Note 1, under note 1, the revenue reserve given here is 96. 96, and for the year, they said retained earnings for the year 72. 72. The one provided there is 72. So for you to determine post, because we have for the year 72, so to determine post is just for the year 7. That is you just apportion these. So from here to here is they are half of these. They are half of 72. So you come here and say 30% times. They are half of 72 is 7,200 divided by 2. 3,600. So 30% of that is 1080. In note 4, there was a period when Poro sold goods to Allo. Poro sold goods to Allo. The goods were sold at a price of 780 million. When Poro was selling, he made a markup of, when he was selling these goods, he transferred at a markup of 30%. 30%. But at the end of the year, the goods were unsold here in Allo, but not entirely. He sold some. Some were unsold. 2/3 of the goods. That is not 4. 2/3 of these goods were still in the inventory of Allo. 2/3. So that is how you determine unrealized profit on stock. unrealized profit on the goods which are in the stock of this company. Unrealized profit on the stock of this, meaning that the profit of borrow is overstated. This profit of borrow is overstated. It's overstated. This profit is overstated. In this company is overstated. So meaning that what you will be taking from that other company called Allo must be reduced by the unrealized profit. Must be reduced by the unrealized profit, which is unsold goods, which is 2/3 of 780 times what? Times margin. Remember that to change markup to margin, UPS is unsold goods terms. UPS is equals to unsold goods times profit margin, not markup. So if you are given markup right now, markup, you are told markup is A over B. Margin will be A over B plus A. A over B plus A. That is A over B plus A, meaning that for this one is 30 over 100. So meaning that margin will be 30 over 130. It's like 2. That is 3 over 13. So unsold goods is the value is 520 times 3 over 13. So that is 120. So that one must be reduced here. These what the parent is getting from this company as investment must be reduced by that UPS, which is equals to 30% of that 120. Because it was controlling this company by 30% times 0.3, that is 36. So our investment there will be 7560 plus 1080 minus 36. So that is 8604. This is working one. That is working number 1. So 36 what? 04. That is 86, sorry. 8604. Then after that, there's other workings I need to do here. Working 2. So another working 2 is concerning other investments. How is this one will be tested? Other investments. We need to test if there's other investments. We need to test if there's other investments. If there's other investments. So we can test. Remember that when Paul was acquiring Sora and Allo, he paid something. He paid something. And we computed that. When I was doing goodwill, the purchase consideration. We computed the purchase consideration. But also the investment is given in the statement of financial position. If you can look at in the statement of financial position, you can see there is investment given. So investment, that is 48,000 and 10,920. So we need to do a comparison here. So when Paul was investing in these companies, when he was investing in Soro, the investment given he paid is 48,000. 48,000. And in Soro, he paid 10, 9 what? 980. So remember that I can do it very simple before I do it direct. I can interpret more. So if you add these two, 48,000 plus 10,920, that is 58 Here, this is 58,920. But remember, you were told this, huh? He paid what? The one we computed now. But this is as per the balance sheet. Huh? But now, based on the current price, he paid the one we computed under goodwill, the purchase consideration. Those are the current purchase price, the current purchase price. So remember that in Soro, when we were determining the purchase consideration, it was some amount. It was 38,880, and in Poro, when we computed the purchase consideration, remember for Soro we took in Soro, remember we took 90% terms. The purchase consideration, which is 14,400, divided by par value times the current price, which is 30. Then for the, so this is Soro. For our load is this one, 75,60. For the other one is 75,60. So this one totals to, this totals to what? So 38,880. 38,880 plus 75,60. 38,880 plus 75,60. That is 46. So meaning that they are supposed to be the same, but they are not the same. Eh? So meaning that the difference is other investments. They are supposed to be equal, but they are not equal. So the difference will be, so I will come here and say, Sores investment in Soro at cost. This is at cost, not at fair value. So investment in Soro so this one at cost. Just the difference. It's only that I'm now doing it in an organized manner. And the investment in allo at cost. So we raise 38 here, so that we have the difference, 38,880. And what? 75,60. So if it could have been zero, if we deduct this and we find zero, that is when we say there is no other investment. So, but now there's a difference. So 58,920 minus the 2, we get here 12,480. So also there was another investment. There was another investment according to note 6. On 1st November 2021, Soro owned an investment property that had a fair value of 1440 in excess of the book value. So we'll be able to add it there. So you will be able to add fair adjustments. Add the one which is the fair value adjustment. Fair value adjustment. That is Soro investment property. Soro's investment property. Soro's investment what? Soro's investment property. So it has to affect this one. So you add that to 1440. According to note what? Note 6. So plus 1440. That is 13,920. 13,920. So other investment property. Other investment property. So other investment property there is 13,920. And this is working too. So that is working too. That is working number 2. So we are done with the total and current assets. We can get the total there. So 139, 800 plus 14, 880 plus 1440 plus 86, 04 plus 13, 920. So this one will be 178, 644. Total and current assets. Then we go to the current assets. It doesn't have a lot of work. They are more direct. So the current assets. So for the current assets, the first one is inventory. We have the inventories, parent plus subsidiary, 9960 plus what? Plus 4080 plus the 4080. Nothing to be adjusted. So this is 14040. 14040. Then trade receivables. Trade receivables, that is 6240 plus 3480. So trade receivables. But now there's something they mentioned concerning check. A check of 480 from Soro to Poro was not received until 3rd November 2023. 3rd November 2023, meaning that that amount had not yet been paid by the end of the year. It had not yet been paid by the end of the year. But they were more specific. They went as ahead to say that the intercompany balances are included in the accounts receivables and accounts payables. Are included in the accounts receivables and accounts what? Accounts payables. Are included in the accounts receivables and accounts payables. So we need to adjust that amount. We need to adjust that amount by deducting where? Under these receivables, because this amount, yes, was received. It was received. So I need to interpret here a bit so that you understand the double entries for this. Remember, this amount was outstanding, but it has been received after the end of the year. It was not received by the end of the year. It was received a few days after the end of the year. And they have said that any intercompany balances which is outstanding by the end of the year, it's included under receivables and payables. But this amount has been paid, so we need to record. We need to record. So record, it's a check. So debit bank, because it had been paid, we credit what? Credit receivable. Crediting receivable is deducting. That is why I've deducted here. Then I will come to bank, which is the next one. Bank balance. Bank balances. I'll come to bank balances. So under bank balances, I will come here and say 2880. Now we add this. We have recorded. Now see, this amount was received by the end of the year by reducing our debtors, and then we receive that amount at the bank. 6240 plus 3480. So this is minus 480. This is 9240. We have 9240 there. Then 2880 plus 480. That is 33 what? 60. Up to this point, we have total assets. The value for total assets will be 205 284. 205 284. And let's talk about equities and liabilities, then we will be done with this question. I think we are within the time. It's just 55 minutes we have used. 55 minutes has been used. So equity and liabilities. So equity and liabilities. So for the equities and liabilities, so equity, we talk about equity. So for the equity, we talk about ordinary share capital. Ordinary share capital. The ordinary share capital. Here we have shillings in million. So shillings. Ordinary share capital, you pick for the parent only. You pick for the parent only. That is 60,000. This is a free mark. Revenue reserve, it needs a working. Revenue reserves needs a working. Then now we need to check the capital of the minority shareholders, the non-controlling interest. We need to introduce non-controlling interest. Then CIs is another working needed. Before those two workings, we can record others. Then we embark on doing them. Then non-controlling interest, non-current. Those non-controlling interest we have recorded. We go to non-current liabilities. Non-current liabilities. So for the non-current liabilities, we have 10% debentures. 10% debentures. That is 6,000 plus 2880. So 6,000 plus 2880. That is 80. That one. Then current liabilities. For the current liabilities, I would say trade payables. Trade payables. 50, 40 plus the subsidiary, which is 15, 520. 50, 40 plus 11, 520. So this is 16, 560. Then after that, we talk about current tax. Current tax is 50, 40 plus. Then OD, bank overdraft. So this one is only 22. So it's like from here going down, it was 3 marks of adding and that just adding parent plus subsidiary. So total equity and liabilities. So before we get total equity and liabilities, remember we have two workings to be done. We have the working for NCI and we have the working for revenue reserve. So I can start with the working for revenue reserve. These are retained. I can start with revenue reserves. The same as retained profit. This is a retained profit. So we have 3 entities. Here we have Poro, Soro, and Allo. So we have Poro. I will do that in a direct way. Soro, and we have Allo. That is Allo. Anyway. So there is that retained earnings given as at the statement of financial position. As at which date? 31st October. As at 31st October 2023. We have balances from this statement of financial position. Some balances from the statement of financial position. So for the parent, its retained earnings was 87,600. 87,600, 26,400, and 16,800. So that is as at 31st October 2023. So we need to find what the parent is getting from these entities, the time they existed. Remember, Soro was acquired on November. So from 1st November to end of the year, which is 31st October, that period. So we need to get the profit the parent is getting from this and this during that period. Meaning that any profit which was outside the time this company were acquired, we need to deduct so that we remain with only the profit which the parent is getting from those companies based on the time they existed as subsidiary and associates to the parent. So meaning that I have to look at pre-acquisition retained earnings. I deduct res pre-acquisition profit. I need to res pre-acquisition profit, of which when Soro was acquired sometimes back, and that is November. As at that date, which is the start, as at November, when it was acquired, remember that it was acquired 1st November 2021. Our financial year starts when? Our financial year starts on, because it ends on October, it starts November 2022. So there's something I need to make clear. 31st October 2023. So for this company, we need this profit from this period to this period, this period here. We need that profit. That is what we need this profit. That is why I'm deducting this profit which was there as at the time of acquisition, which is the opening here. So I need to deduct that. I need to raise it so that I remain with, because this one is inside this. By the end of the year, this one is here. It's inside the 26,400. So I need to deduct. Then for the other company, remember it was acquired during the year May 1st. So we have 6 months. So I need to deduct this profit. I need to deduct the profit for the first 6 months. And I think we computed it somewhere. We did it somewhere because the balance brought down is 96. Then profit for the year was 72. So what we did, we apportioned 72 for the first 6 months, then we added to 96 because that is the opening balance. It was given somewhere in note for alloy is 96. So it's a coincidence, it's a part of Soro. 6, which is retained earnings as acquisition date of Soro, and at the same time, the balance given in note 1, the revenue reserve for alloy, that is alloy, is 96. So it's a coincidence plus 6/12 times 72. That is what we say for us to get this pre-acquisition period. So 7,200 divided by 2 plus 96. I can confirm that if I take 9,600 plus 72, I will get 16,800, meaning that with the last 6 months only. So up to this point, we have some amount. We have this amount. So this is a profit for the year so far. So the only thing I will be able to record here is the license, which is supposed to be written off. License written off. Why? Check under additional information number 3. This is under SORO. Additional just prior to acquisition, SORO was successful in applying for a 6-year license to dispose waste products. It went successfully. The license was granted by the county government at no cost. At no cost. But what SORO did, SORO went ahead to estimate that the license was worth 2160. So at the date of acquisition, so that one we have to write off. He went ahead to do an estimation. So as at the date of acquisition, from the date of acquisition, that is November 2021. From 2021 November to 31st October 2023, that is 2 years. So 2 years out of the 6, because it was 6 years. The license applying for a 6-year license terms 2160. So for the 2 years, so 2/6 times 2160 times 2/6 times 2160. That is 720. So reduce this here. It was for free. So we have 87,606. So here we have a profit in SORO. After adjustment, we have this profit and we have this. So the parent will take. So in SORO, he will take. In SORO, he will take his share in 0.80. So you will take that one, and in a law, you will take the 30% of that profit. 30% of 36. That is what we will add to the profit of the parent. That is what is supposed to be added to the profit of the parent. So here you will take 14 from this SORO. You will take 14,472. Then from the other one, you will take 1080. So that the total profit here will be, you just add the total profit for the parent will be, so you add this. And because you remember, there's one thing after getting this one, and the profit to the profit of the parent must be reduced by one thing. Anyway, before I add this 14, anyway, I can say this profit of the parent, I can deduct it at the end. I don't have to clear. We are correct, but there's one thing I need to deduct. I will explain which item we have not deducted. So this is 103, 152. But now we need to raise UPS. Raise UPS. Because when Paul was selling goods to this company, remember this entity never sold what? Or the goods. There's 2/3 which remained in the UPS was 120. Was 120. So we said 30% of 120 was, because the parent control arrow up to 30%. We got 36. Our answer will be, so if I say 103, 152 minus 36. So this is the final answer will be 103, 116. So 36 must be reduced because this company sold goods to this. That is under additional information number 4. Poro sold goods to Alo at a markup of 30%, but Alo never sold all the goods by the end of the year. So there's unrealized profit here, which is realized by the parent, meaning that this profit is done what? It's overstated. So we have to deduct that overstatement based on the unrealized profits in the stock of Alo. So working number what? So working number 3, we have 103, 116. Finally, last but not least, the last but not least, we have non-controlling interest. Non-controlling interest. We have the non-controlling interest. We talk about non-controlling what? Interest. This one is just a simple. So you just start with the fair value of the non-controlling interest, which is provided. That is according to note 2. Note 2. It was measured at 3,600. 3,600. That's 3.6. 3,600. Then after that, you add the profit. Add the profit. The post-acquisition profit. Post-acquisition what? Post-acquisition profit. Post-acquisition profit. We have just done what we call retained earnings. So when we adjusted Solo from that column of Solo, remember that it was we started with 14,400. We deducted pre-acquisition. We deducted the pre-acquisition. So we took 14,400 minus the acquisition of 9 to be written off of 720. So was it that way? Was it 14 or 26? It was 26, not 14. The retained profit was 26 minus 96 minus 9,600, which is the pre-acquisition. Then we deducted the license to be written off. We remained with 1608. Yeah. Remember that is what we say 30% here of what? Of that. So we said 26 revenue reserve. When we were doing revenue reserve, I explained more of this. I don't have to explain again. Why am I doing this? I explained. For us to arrive at 16,080, I explained. So times 30%, that is 40 what? Times not 30%. Remember that 30% is for the associate. NCI is the parent Bolo controlled Soro up to 90%. So mean that NCI is 10%, not that 10%. So 10% of this, it will be 26,400 minus 9,600 minus 720 times 0.1. That is 160 point what? That is 1608, not 160. 1608. So our total will be 3,600 plus 1608. So that is 5208. So that is what I will record here, 5208. So let's check if the total equity and liabilities are equal to total assets. And remember, this was 60,000, not 6,000. The ordinary share capital of the parent is 60,000. So 60,000 plus 5208. Up to this one, our shareholders fund plus 8880 plus 16,560, 16,560 plus 9240, 205, 200 and what? 284. 205, 200. The balancing figure. So it's not all about balancing because they don't mark the balancing figures. I think students, professionals, you know that. When Kasneb marks this question, which is having 16 marks, when they were marking this one, it was having 16 marks. For you to get 16 marks, they 4, 5, 6, 7, 12, 13, 14, 15. So out of the 15 entries, they needed only 8 correct entries. 8 times 2. You get your 16 marks. Get your 16 good marks. 16 marks. So it's not all about getting everything. 8, 9. So there were many direct entries, just adding parent plus subsidiary. They never needed anything else. Parent plus subsidiary, parent subsidiary. You could have scored the 16 through the entries which were in need of just adding parent plus subsidiary. But this is how generally this question was supposed to be done. So this is a question for consolidation, April 20.